Now let us look at Rule 12 and Rule 15. Rule 12 of the company's share capital and debenture rules 2014 is about issue of shares under ESOP and employee welfare schemes. So the summary of Rule 12 is: number one, Rule 12 requires that there must be a special resolution. As far as the pricing is concerned, Rule 12 says it is at the discretion of the company. And then it talks about the vesting, which is only for the continuing employees. So by default, it would mean that the options or the ESOP schemes will be entitled only to the continuing employees. So the employees who leave the organization, by default, their rights or their grants under the ESOP schemes are frozen, and they're eliminated, they're cancelled. Administration by compensation committee. So not only Rule 12 talks in terms of the compensation committee, even the SEBI regulation on share-based employee benefit and sweat equity regulation 2021 also has a provision of appointment of compensation committee. So that means this is a committee which is appointed by the board of directors that would do the administration of the ESOP schemes of the company. As per the SEBI regulation, the role of the compensation committee in case of certain companies, or certain companies can decide to delegate the function of the compensation committee to the HRC committee, the HRC committee of the company. So instead of having two committees, HRC and compensation committee, a company will have a choice that it can decide to delegate the role of the compensation committee to the HRC committee of the company. Disclosure, of course, there are mandatory and they need to be given as part of the explanatory statement, which is attached to the notice when the company is seeking approval for the issuance of ESOPs from the shareholders. And the company is also required to maintain Form SH6 for as per the Rule 12 for recording the ESOPs granted by the company. Rule 15 is about disclosure and accounting of employee benefit schemes. And here is what does it talk about? It talks about, number one, annual disclosure in director's report. So as per Rule 15.2, it is mandatory for the company to give complete disclosure about the ESOP schemes of the company in the director's report. As far as the accounting is concerned, Rule 15 mandates that if it is a listed company, the company will have to do the accounting as per Ind AS 102, and if it is unlisted company, then the company will need to do the accounting of ESOPs as per the AS 20. So remember, if it is a listed company, obviously Ind ASs are applicable. So if the Ind ASs are applicable, listed company will have to do the accounting of ESOPs as per Ind AS 102. Whereas if it is unlisted company, or it is a company to which Ind ASs are not applicable, or it is a company which is a private limited company, then the accounting of ESOPs will need to be done in compliance with AS 20. Then the requirement of Rule 15 is impact of intrinsic versus fair value. So disclose the difference in profit and EPS if intrinsic value method is used. Specific employee-wise details. So Rule 15 also requires mandatory for KMPs. So in case the KMPs or the directors, if they have got the ESOPs given to them as part of the ESOP schemes, then these details will need to be specifically reported in the director's report as per the requirement of Rule 15.